Okay, so picture this. Two job offers, same title, same city, same industry. One pays $95,000, the other pays $82,000. You take the $95,000 offer, obviously. And 6 months later, without quitting, without getting a pay cut, without doing anything wrong at all, you are worse off financially than you would have been at the $82,000 job. How is that possible? Here is what happened. Your employer is paying you in two forms. Most workers only ever count one. Your salary is the paycheck that hits your bank account. But there is a second paycheck, and almost nobody calculates it. It never shows up as a deposit. It does not appear on your pay stub. It is not on your W-2. But it is real money being paid for you every single month. And for most professional workers in America, it adds up to somewhere between $15,000 and $40,000 per year on top of their salary. All right, let me show you what I mean. The average full-time worker in a professional role costs their employer about 30% more than their salary suggests. The Bureau of Labor Statistics tracks this down to the dollar. In 2024, the average civilian worker cost their employer $46.14 per hour total. But wages and salary only accounted for about 69% of that. The other 31% was benefits. Nearly a third of what your employer spends on you never touches your checking account. That 30% is the paycheck nobody told you about. Okay, the biggest piece of that hidden paycheck is health insurance. And the numbers here are not small. The average employer in America right now contributes about $7,034 per year toward a single employee's health coverage. That is not what you pay out of pocket. That is what your employer is writing to the insurance company on your behalf every year, in addition to what you contribute. But if you have a family plan, the number is completely different. The average employer contribution for family health coverage is $17,393 per year. Check this out. That is $17,000 a year going to an insurance company with your name on the policy. And most workers do not even know that number exists. Your employer's health contribution does not appear in your taxable income. It bypasses income tax, state tax in most states, and payroll taxes entirely. For a worker in the 22% federal bracket, that $17,000 benefit is worth more in after-tax terms than $17,000 in cash would be. So when someone takes a job offering a few $1,000s more in salary, but no health coverage, the first question they need to ask is, how much would I have to pay to replace this plan on the open market? For a family, the answer is often $15,000 to $25,000 a year. The salary premium evaporates immediately. Now add the retirement piece. The most common structure for a 401k match is 50 cents on every dollar you contribute, up to 6% of your salary. On an $82,000 salary, that means if you contribute 6%, $4,920, your employer adds $2,460 on top. That is just your employer handing you money the moment you put yours in. Not investment growth, not market return, just a direct transfer the instant you contribute. An immediate 50% return on the day you contribute before a single dollar of investment growth happens. And if you compound that $2,460 over a 30-year career, you are not talking about a small number anymore. You are talking about a six-figure difference in retirement wealth from the match alone. Yeah. About 25% of workers with access to a 401k match are not contributing enough to capture the full thing. They are leaving salary on the table. Their employer has explicitly committed to pay them that money, and they are not picking it up. Then there is paid time off. This one feels different because it does not seem like money. It just feels like days, but it is real income. When your employer pays you for a vacation day, they are paying you to not work. That is income you receive without performing labor. Here is how to calculate it. Take your salary and divide it by 2,080, which is the number of working hours in a year. That gives you your hourly rate. Then multiply by the number of paid days you receive, counting vacation days, sick days, and paid holidays. On an $82,000 salary, your hourly rate is about $39.42. If your employer gives you 15 vacation days, 10 paid holidays, and 5 sick days, that is 30 working days of paid leave. 30 days times 8 hours times 39.42 is about $9,461 per year in income you receive without working. That number surprises most people the first time they run it, and the reason it surprises them is that this income is invisible until you calculate it. It does not exist at a job where you take unpaid time off, where you are a contractor billing only the hours you work, or where you do not get holidays. Stack in the rest, and the total climbs further. All right, dental insurance. Your employer typically contributes $360 to $1,200 per year toward the premium. Vision, another $120 to $480. Life insurance. Most employers provide coverage worth 1 to 2 times your annual salary at no cost to you. Replacing that life insurance on the individual market would cost you several $100s a year. Short-term and long-term disability insurance. If you become unable to work, these policies pay 60 to 70% of your salary. Buying individual disability coverage on the open market runs 1 to 3% of your salary per year. And on an $82,000 salary, that is $820 to $2,460 a year, your employer is covering. Add it all together on that $82,000 job. Employer health contribution for a family, $17,393. 401k match at 4%, $3,280. PTO value at 30 days, $9,461. Dental, vision, life, and disability, about $2,000 combined. Total benefits value, $31,134 per year. Total compensation, $113,134. And the $95,000 offer with no benefits, total compensation $95,000. You did not take the better offer. You took the one that looked better on paper. Understanding why we never think about this as a second paycheck requires understanding where the phrase benefits came from in the first place. And the answer starts with a wartime wage freeze. The system was not designed. It grew out of a legal workaround that nobody expected to outlast the emergency that created it. In October of 1942, the United States government was fighting a war. Millions of men had left the workforce for military service. Employers were competing fiercely for the workers who remained, bidding wages up and threatening to fuel inflation at exactly the moment the country needed economic stability. So Congress passed the Stabilization Act, which froze most wages at their September 1942 levels. Employers could no longer raise cash pay, so they competed the only other way they could. The National War Labor Board, the 12-person federal body charged with enforcing the wage freeze, had to decide what counted as wages under the freeze. They decided that health insurance and pension benefits did not count, and those could grow in what they called a reasonable amount. Employers who could not offer $1 more in salary could offer a health plan instead. These were not cash. so the government did not count them as wages. Within 4 years, the percentage of Americans with some form of health insurance jumped from about 9.8% in 1940 to nearly 30% by 1946. And here's the word the War Labor Board used for what those employers were offering: fringe benefits. Fringe, as in peripheral, secondary, not really wages. That word, coined by a federal wartime bureaucracy to describe a legal workaround, embedded itself in the American vocabulary. 80 years later, people still hear the word benefits and think extras. The invisibility was baked in from day one. All right, not everyone has access to this second paycheck. The benefit system creates two Americas inside the same labor market, and the gap is large. For management, professional, and financial workers, the BLS reports that about 94% have access to employer health insurance. For service workers, the cashiers, cleaners, cooks, and caregivers who make up an enormous share of the American workforce, that number is 52%. And for retirement benefits, it is 90% versus 47%. For part-time workers, the gap is even wider. Only 25% of part-time workers have access to employer health coverage versus 87% of full-time workers. And then there are gig workers. An independent contractor who charges $75 per hour and works 1,800 hours a year has a gross revenue of $135,000. That sounds strong, but they also pay 15.3% in self-employment taxes, covering both the employee and employer halves of Social Security and Medicare. They buy their own health insurance, which for a family plan runs roughly $12,000 a year. Every day they take off is unpaid, and 30 days off is about $12,000 in lost income. And there is no retirement match. Run the full calculation, and that $135,000 often compares unfavorably to a salaried worker earning $90,000 with full benefits. The nominal hourly rate is real, and so is the gap between that rate and what actually ends up in their pocket. And that gap runs the other direction from what most people assumed. Okay, so what do you do with this? Most workers know only one of those numbers. The second one, total compensation, which is salary plus every dollar your employer pays on your behalf in benefits, is the number that actually tells you what the job is worth. To calculate yours, start with your salary. Then call your HR department and ask what your employer contributes to your health insurance premium. They will have that number. Add the maximum 401k match you can capture if you contribute enough. Calculate your paid leave value using your hourly rate times the number of paid days you receive annually. Add dental, vision, life insurance, and disability coverage at their replacement costs if you can find them. That total is what your employer actually pays for you. It is usually substantially larger than people expect. For a professional worker with full benefits, the gap between salary and total compensation is commonly 25 to 40% of base pay. Now, use that number every time you look at a job offer. Before you accept a higher salary, calculate the full package. Before you go independent or take a contract role, calculate the benefits you would need to replace. Before you negotiate a raise, know whether the raise addresses the full compensation gap or just the visible part. The information was always there. The vocabulary was just designed to make it feel like an extra, a perk, a fringe. Yeah, the word fringe was always wrong. This is the other paycheck. Yeah, there is a line from the Bureau of Labor Statistics that most people will never read. It is in their quarterly employer costs for employee compensation report. It says that for the average American worker, wages and salaries represent 69.4% of total hourly compensation. Benefits represent the other 30.6%. Almost a third of what you earn is paid in a form that never appears in your bank account and almost never enters your mental model of your own income. Every job offer you have ever compared by salary alone was a comparison made with 69 cents of every dollar's worth of information. Every salary negotiation that treated your paycheck as the full picture was a negotiation that left the other paycheck on the table. Most workers never calculate the gap between what their employer deposits in their account and what their employer actually spends on them. The workers who do calculate it negotiate differently, compare offers differently, and make career decisions differently. The number your offer letter shows you is real. It just does not include the other paycheck.